Good afternoon, ladies and gentlemen. This is Robert Rayburn. I hope that everyone had an absolutely fantastic long weekend and you were able to spend time with friends and family and perhaps barbecue a little bit. But without further ado, we want to go ahead and get started with this week's update. We have a lot to talk about. And the first thing we want to talk about, we will review, is the performance. And quite frankly, it's sucked year to date. For the first time since our firm was created, we've been trailing the market. And we want to break down the reasons why, because we've made some intentional and bold steps to transition away from technology. And we're going to go why we're transitioning away from technology and why it's so necessary. And sometimes those transitions can be messy. So let's go ahead and get started. I'm going to share my screen here. And the title of this week's market update is The Great Stock Market Civil War. And when we look at really how 2021 has unfolded, those headline indices really show pretty good performance. But underneath the surface, what we're seeing is this big battle that's taking place between the deflationists and the inflationists. And what we want to understand at the end of the day is not to try and see how we can win each battle, but how can we understand who's going to win the war and then position the portfolio not for the winner of each battle, but for the winner of the war. And if we think of what are the three messages from this week's update, first is, despite the rise of deflation fears that we've seen over the last month, a month and a half, all we have to do is walk outside, go to a restaurant, try to hire someone. It is incredibly challenging from a price perspective. We do not see, either in the data or in real world experiences, anything that suggests to legitimize the rise of these deflationary fears. A lot of this is just a mean reversion trade that's taking place in the overall market. So the three messages here this week are: inflation does appear sticky at this standpoint, not transitory. So we want to understand, how can we make money in an inflationary market? And so we pull out those 1970s playbooks that we've kept hidden in the drawers for so long. And we also want to make sure our timeline is long enough. We are investing for a 12 to 24 month time frame. Third, technology stocks under the surface continue to deteriorate. And they may seem bizarre given that the NASDAQ just hit a record high, but we're going to show how breadth continues to deteriorate. Fewer and fewer stocks are participating in the rally. Now, we haven't done a performance update in a while because we wanted to move toward a monthly and quarterly review. But here, real quick, as I said, the performance understandably has sucked. We're down 8% versus a rise of 15% in the S&P 500. But here's the good news: is over time, stock picking ultimately works. And what we see here is, since inception, we're up 200.81%. In other words, we've been able to outperform the stock market by over 107.86% after fees. And if we break this year by year, 2021 really has been the only year where we've experienced some struggles. And that's because we're transitioning the portfolio. We're transitioning away from that 4-year overweight position in technology. And here's the thing: if we think about why we're doing that, it's because technology is incredibly expensive, trading at north of 60 times PE as a sector. The last time that happened, the 2000 tech bubble. Now, think of it this way: tech has been, for those longer term clients will be able to sort of back this up, tech's been our key overweight, and we're up over 200%. What does that tell you? A group of diversified technology stocks is 200% more expensive than they were 4 years ago. So we really do have this in the back of our mind. At the end of the day, bulls make money, bears make money, pigs get slaughtered. And we don't want to be greedy in a lot of the winning stocks that we've had over the last 3 or 4 years. And we want to set up existing clients and new clients ultimately to be able to outperform the market, not just over the next month or two, but over the next year, 2 years, 3 years. And that's why we had to reposition the portfolio away from the expensive areas of the market and toward the cheaper areas of the market. Now, as we talked about, yes, the NASDAQ hit a record high. But notice what's happening here with the chart over on the right. What we're seeing is the number of stocks hitting new highs is rapidly deteriorating. And what we also see is that the relative performance of the equal weight tech index relative to the cap weighted tech index is rolling over. Very important point, because the NASDAQ is cap weighted. Google, Netflix, Amazon, Facebook, etc. dominate, Tesla dominate the overall index. When in reality, most of the stocks are not hitting new highs. They're actually beginning to roll over. And you'll notice the NASDAQ has hit new high after new high over the last 4 or 5 days. But something like the ARK fund is actually has sold off about 6 or 7%. That's a very important point, because they are very emblematic of those high multiple areas of the stock market. And the other thing interesting is in June, yes, the market rose, but 286 stocks went down and only 219 stocks went up. Again, very emblematic of this narrowing breadth that's taking place, specifically, more importantly, within technology. Now, when we think of the overall world, we're kind of breaking this down into reflation versus deflation. And a lot of the stock market right now is being controlled by the direction of the 10-year interest rate. Now, why is that? The 10-year interest rate is a short-term trader's reflection right now of views of reflation versus deflation. In other words, when the 10-year yield is going up, traders are saying that GDP is going to accelerate. And when GDP accelerates, what do we want to be positioned in? We want to be positioned in highly economically sensitive areas of the market, such as oil, the banks, metals, industrials, small caps, consumer discretionary. And then vice versa. When the 10-year yield goes down, traders are expecting GDP to decelerate. In other words, we want to be positioned in areas of the market that don't need high economic growth to make a lot of money, such as technology, biotech, mega caps, bonds, utilities, consumer staples, those bond-like equities, and those technology stocks that where most of their growth is going to take place 5 or 10 years out in the future. Right now, our data, and we're going to go through the charts, suggests that we are in this camp, in the reflationary camp. And we're going to go through why. But we expect this 10-year interest rate to increase. And as those 10-year interest rates increase, we want to be positioned in highly economically sensitive areas of the market. And we see that in the way the market has worked this year. We had the great COVID deflationary shock, and then obviously the stock market rebound. As a result, we wanted to be overweight technology, which is what we were, and we were up over 100% last year. But this year has been sort of a seesaw. We had first this great reopening reflation, selling down technology, selling down a lot of the biotech stocks, and going into those economically sensitive areas such as oil, the banks, industrials. More recently, we've had a doubting of reflation. We've seen this as a result lead to a fall in the 10-year interest rate, as traders have said, well, we expect the economy now to decelerate. And as a result, money has moved back into technology. But we think this is a head fake, and we're going to go through why. So first of all, the 10-year interest rate, ladies and gentlemen, when we were in a falling interest rate environment prior to COVID, we were trading underneath the 200-day moving average. In other words, we were in a downward trend, emblematic, encapsulated by the flattening yield curve. This time around, we are in a steeper yield curve environment, and we're in a positive trending environment above the 200-day moving average. In fact, we saw how interest rates got overbought. In other words, bonds got oversold, and we're merely working off that oversold or overbought condition, however you look at it. We're working off that overbought condition back into the moving average. We're now in a position where interest rates, we can see here on the overbought, oversold RSI indicator, are significantly oversold. As a result, we expect interest rates to start to rise. Okay, so oversold, interest rates start to rise. What does that mean? That means the market interprets that as a reacceleration of GDP. And what does that mean? Well, we want to go back into those highly economically sensitive areas of the market, such as oil, banks, energy, etc. That's why we are positioned in the portfolio the way we are, because we are anticipating what's going to happen in the late summer, the fall, and the winter months of 2022. So, inflation or deflation? Let's let the charts decide. This is headline inflation, ladies and gentlemen. We see here there is, a picture says 1,000 words. CPI is massively accelerating, whether we look at a bar chart format or a flow chart. We see is massive acceleration. Now, part of what's taking place is we're coming over easy year-over-year comps where we were in deflation, which is exaggerating this move upward. So what we wanted to do today is look at not just those year-over-year percentage gains, but look at the actual price data. What it actually costs to buy something today versus prior years before COVID. So let's look at the price breakdown here. We're going to do one more year-over-year comparison. These are the core services versus core goods, both services and core goods, minus the cost of food and energy. We see, again, a dramatic spike. And we also see price growth in those key consumer cost centers. So this is, your typical household would spend money on medical care, shelter, at home, food at home, energy, commodities, etc. A sharp acceleration here and to the right. So let's remove the comps. So what we see here, these are the actual prices paid. So this is not being skewed by year-over-year data from when COVID shut down the economy. We see here is 79.5 is some of the highest prices paid on the ISM survey since 2007, since 2004. This is real inflation. This is not being skewed by the shutdowns of last year. Let's look over here. ISM prices paid over, the prices paid over from a longer term time period. This was the services. This is more manufacturing, pardon me, on the right here. On the manufacturing, we see the same thing, hitting new highs. In fact, going all the way back to 2002, the prices paid today, so again, not year-over-year percentages, the actual price, the sticker, is the highest we're seeing over the last 25 years. Again, these are important points that we need to consider. Wages, actual aggregate wages, all-time highs. Then we look at that 2-year growth, right? So we look at the 2-year growth so that we remove the effect of 2020 and those COVID shutdowns. Again, hitting cycle highs. Wage inflation is sticky inflation. Why? Because that allows spending power to increase. And what's one key difference between 2009 and today is that we came out of 2009 and consumers were burdened with debt. They had to pay that debt down. This time around, consumers aren't delevering, they're relevering, and they have a huge amount of savings. It's the first recession that consumers are exiting the recession with more money than when they entered into it. And that's driving demand. Inventories are low, and guess what happens? Prices go up. This is sticky inflation. We see this in the used car market. A lot of us have experienced that. We look at durable goods, skyrocketing year-over-year inflation. Fuel prices, gasoline at the pump, right? This is going all the way back to 2015 and beyond. Again, not skewed by year-over-year numbers, hitting multi-year highs. So the question becomes, if this data is correct and inflation is sticky, do we want to position the portfolios for deflation and try to chase returns over the next week or next 2 weeks? Or do we want to position the portfolios for a more sticky inflationary environment that can help clients make money over the next year? We're in the camp that we're in a sticky inflationary environment, and we want to position clients for success over the next year. That has resulted in us sacrificing some short-term returns in the month of April and May and in June to adjust the portfolio for this new environment. This is not an adjustment that happens very often, but we had to make it. We had to rip the Band-Aid off and position clients for success over the next year, 2 years, and 3 years. So overall, this whole deflation trade over the last 4 weeks seems downright bizarre. what we do see is that price data is pointing towards sticky inflation. Bonds are severely overbought here, so we do expect interest rates to move higher. And as a result, we want to position the portfolios in stocks that do well in rising interest rates. In other words, economically sensitive assets. Thank you so much again for all your business, for your patience. We know the last 3 months have been kind of a grind. We've been going up and down in this channel while the market's been going up. We appreciate it. We are cognizant and empathetic toward it. And I can assure you that, the way we're positioning these portfolios is for that 12 to 24 month success, not the next 1 or 2 or 3 weeks. So if anyone has any questions, please feel free to reach out to your advisor or us here at our offices at 888-543-3776. Otherwise, have a fantastic weekend, and we'll speak again next week. Thank you.